Have you ever wondered how to invest in stocks as a beginner? If so, you're in the right place. The world of investing can seem daunting at first, but with a strong understanding of the basics, you'll be well on your way to financial savvy. Today, we're going to unravel the mystery, starting with the main asset classes: stocks, bonds, cash, and alternatives. We'll discuss their characteristics, advantages, and disadvantages. You'll also learn about the power of diversification and why holding different asset classes can benefit your portfolio. Plus, we'll delve into the various investment options available and how to choose the best one suited to your goals and risk tolerance. Whether you're interested in active or passive investing, individual securities or funds, or robo-advisors or human advisors, this is your starting point. So if you're ready to embark on your investment journey, stick around. Before you start investing, it's crucial to understand the different asset classes. Let's dive in and discuss these four primary asset classes: stocks, bonds, cash, and alternatives. First, we have stocks. When you buy a stock, you're buying a piece of a company. You become a shareholder who stands to gain if the company does well, but also bears the risk if the company doesn't perform as expected. Stocks generally offer the highest potential returns among the asset classes, but they also come with the highest level of risk. Next, let's talk about bonds. Bonds are essentially loans you give to a company or government. In return, you receive periodic interest payments and the return of your initial investment at the end of a predetermined period. Bonds are generally considered less risky than stocks, but they typically offer lower returns. Thirdly, we have cash. This doesn't necessarily mean physical currency, but rather investments that you can quickly convert into cash. These might include money market funds or short-term government bonds. Cash investments are the least risky, but they also provide the lowest returns. Lastly, we have alternative investments. These are less traditional and include options such as real estate, commodities, and hedge funds. While these can offer high returns, they also come with a higher level of risk and often require a more substantial initial investment. Now let's illustrate with real-life examples. Suppose you bought a share of a tech company's stock. If the company performs well, your stock value might increase significantly. But if the company fails, you could lose your entire investment. On the other hand, if you bought a government bond, you would receive regular interest payments and get your initial investment back when the bond matures. However, the return is usually lower than what you could potentially gain from stocks. Knowing the differences between these asset classes can help you make informed investment decisions. Remember, it's not about picking the best asset class, but rather choosing the right mix that aligns with your financial goals and risk tolerance. So, take some time to understand these asset classes and consider how they might fit into your investment strategy. Diversification, ever heard of it? It's a key concept in investing. Let's break it down. Picture a juggler with more balls in the air than hands to catch them. That's diversification in action. Instead of relying on the success of one ball, or in our case, one investment, the juggler relies on the collective performance of all the balls. Now let's turn this metaphor into money talk. Diversification is the practice of spreading your investments across various asset classes, such as stocks, bonds, cash, and alternatives. Why, you ask? Well, it's simple. Each asset class reacts differently to market conditions. When one zigs, another might zag. This dance of asset classes helps to reduce risk and potentially enhance returns. Let's illustrate this with a case study. Imagine two investors, Jack and Jill. Jack invests all his money in tech stocks, while Jill spreads her investments across tech stocks, bonds, real estate, and gold. When the tech bubble bursts, Jack's portfolio takes a significant hit. But Jill, her portfolio dips, but not as drastically as Jack's because her investments are spread across different asset classes. This is the power of diversification. It's like an insurance policy against the unpredictable ups and downs of the market. It's not about picking the single winning investment, but about creating a balanced portfolio that can weather various market conditions. It's a strategic way to manage risk and potentially enhance returns. But remember, diversification isn't a one-size-fits-all strategy. It needs to be tailored to your individual financial goals, risk tolerance, and investment horizon. It's about finding the right mix that suits your investment profile. Diversification, ever heard of it? Now you have, and you've seen its power in action. It's not just a buzzword, it's a fundamental strategy in the world of investing. Remember, don't put all your eggs in one basket. Diversification is your friend. It's a trusted ally in your journey towards financial freedom. So when you think about investing, think diversification. It's your ticket to a more secure financial future. Now that you understand the basics, how do you choose the right investment option? Let's dive right in. Choosing the right investment option is like picking the perfect pair of shoes. It has to suit your style, be comfortable, and most importantly, take you where you want to go. Firstly, consider your financial goals. Are you saving for a rainy day, a new home, or perhaps your retirement? Your financial goals will dictate the kind of investment option you should consider. Next, let's discuss risk tolerance. This is your capacity to endure potential losses. If the thought of losing some money keeps you awake at night, you might want to steer clear of high-risk investments like individual stocks. Now, let's talk about active and passive investing. Active investing is like being the driver of your own car. You're in control, making decisions about what stocks to buy or sell based on your research. On the other hand, passive investing is like being a passenger on a bus. You're trusting the driver, in this case a fund manager or a robo-advisor, to take you to your destination. Looking at individual securities and funds, the former is like buying a single lottery ticket, while the latter is like buying a bucket of tickets. With individual securities, you're putting all your eggs in one basket. However, with funds, you're spreading your investment across a range of stocks or bonds, which can help spread the risk. Finally, we have robo-advisors and human advisors. Robo-advisors use algorithms to manage your investments, while human advisors provide personalized advice based on their understanding of the market and your financial situation. Both have their pros and cons, and the best choice depends on your individual preferences. Remember, there's no one-size-fits-all answer when it comes to investing. It's a personal journey that requires time, patience, and a good understanding of your financial objectives and risk tolerance. Choosing the right investment option is a personal decision based on your financial goals and risk tolerance. Investing can be a minefield, but knowing common mistakes can help you navigate it. Let's start with one of the biggest pitfalls investors often fall into: not having a clear investment goal. It's like embarking on a journey without a destination. You might end up anywhere, and it's probably not where you want it to be. So before you jump into the world of investing, take some time to define what you're hoping to achieve. It could be saving for retirement, a down payment on a house, or even a dream vacation. Having a clear goal will guide your investment decisions and keep you focused. Another common mistake is not diversifying your portfolio. Remember the old saying, don't put all your eggs in one basket. It holds true in investing. By spreading your investments across different asset classes, sectors, and geographical locations, you can spread the risk and potentially increase returns. Remember, diversification is not about owning many assets, it's about owning different kinds of assets. A third mistake is trying to time the market. It's tempting to try and buy low and sell high, but timing the market consistently is nearly impossible, even for professionals. Instead, consider a strategy called dollar cost averaging. This involves investing a fixed amount regularly, regardless of the market conditions. Over time, this can reduce the impact of market volatility on your investments. Lastly, many investors let emotions drive their decisions, often leading to buying high and selling low, the exact opposite of what you want to do. Investing is not about chasing hot trends or panicking when the market dips. It's about sticking to your plan and making rational decisions based on research and analysis, not emotions. Let's illustrate with a real-life example. Consider the dot-com bubble of the late 90s. Many investors, driven by fear of missing out, poured money into internet companies, many of which had little to no profits. When the bubble burst, these investors suffered significant losses. Those who stuck to their investment plan and didn't get swept up in the frenzy were better positioned to weather the storm. By avoiding these common mistakes, you can set yourself up for investment success. So you're now equipped with the basics of investing in stocks. We've journeyed together through understanding the various asset classes, stocks, bonds, cash, and alternatives. We've discovered the power of diversification and how it can help mitigate your investment risk. We've also delved into the critical choice between active and passive investing and how to select the best way suited to your time and needs. And importantly, We've shed light on common investment mistakes to help you avoid them. Remember, investing is not a sprint. It's a marathon. It's about understanding your needs, your risk tolerance, and consistently making informed decisions. The world of investments is vast and diverse, and the key to navigating it successfully is knowledge and patience. Now it's your turn to start your investment journey. Remember, the key to successful investing is knowledge and patience. And don't forget to subscribe to our channel for more insightful videos on finance and investing.